Come to the week ahead, it's a lighter week, but there are a few standout things to be aware of. Firstly, on the Monday, we've got some final prints on the HCOB PMIs and composite PMIs. We can just sort of look through those. The most interesting data point on the Monday is the US ISM non-manufacturing PMI print. Notice how the prior was revised down so significantly lower. 50.5, and before that it was, there was a 52 something expected and it came down, 50.6, and now it's been revised down a little bit lower. So we saw a big drop in services PMI data out of the US. Now that'll be really interesting. Now, if we look at the S&P global services PMI print, that was sort of fairly robust. In fact, you can just see that here. You can see the previous reading for January came in at 52.9. So that showed a nice bump in the data. Now, if you look at the prior, we see that 50.5 reading, which was quite a fall down from that sort of 53 region. And what will be interesting to see is, do we see a nice healthy bump up in the services PMI print? If we see this coming in below market's minimum expectations, there will be an opportunity there in the dollar, because you'll start to see expectations that the Fed may, need to be more aggressive in terms of rate cuts. Now, we have had a really strong non-farm payroll print on Friday, and if you just look how, many jobs were added to the US economy, really doing robust, that does push back the idea of a March rate cut. But if we did happen to see this come in below 50.7, that idea of a March rate cut will come back alive. Now, if it comes in very high, 53, then we could see some more dollar strength, but we just need to find out what's going on with that regional banking sector indices in the US. That was weighing on sentiment towards the end of last week. And if we still see that in the market, then we just be careful of dollar strength. But there is a potential opportunity there with the services PMI print. It's not one to miss. Bond auctions, the shorter end of the curve, they should be fairly robust demand. Then on Tuesday, we've got the RBA interest rate decision. Now, if you look at expectations, markets are not expecting any changes. The dominant theme is that the RBA will be on hold. And you can see that short-term interest rate markets are only really factoring in 2 or 3 rate cuts this year. Now, the latest inflation data out of Australia has been sort of moving to the downside. So last week, the CPI print came in below forecast at 4.1% for the headline, which is down from 5.4% prior, and 4.2% for the core, down from 5.2% for the prior. So that has potentially taken the pressure off the RBA, but some analysts, including ING, are saying that there's still sort of inflationary pressures sitting underneath those falls in the CPI print, and it'll be interesting to see what the RBA say. If they do give a more hawkish stance, look out for the forward guidance in particular. So if they start to stress inflation worries, if they're stressing that they may need to keep rates higher for longer, then look for some potential Aussie dollar upside, and we'll look for that against the New Zealand dollar, because that's the go-to sort of way of trading the Aussie dollar. The risk is a hawkish surprise here from the RBA. Then as we go through the rest of the morning, again, quite a quiet morning. Got some retail sales data out for the Eurozone. We saw the Eurozone just narrowly missed a technical recession with a 0.0% quarter reading, just slightly up from the prior of minus 0.1% and better than the expected minus 0.1%. So Eurozone has marginally avoided a recession. What we're looking for here in the Eurozone is data that's much better than expected, just to give us some reasons for euro buying, just to push back against that negative euro story we've been having. So positive euro data can potentially give us an opportunity for buying the euro. Then we got some New Zealand labour data. Remember, central banks view labour data as inflationary or deflationary. So strong labour market is seen as an inflationary force, and a weak labour market is seen as deflationary. So strong print, then that pushes the pressure on the RBNZ to keep rates higher for longer. Weak print gives them a greater opportunity to potentially cut rates or start moving towards a rate cutting cycle. So that's how the New Zealand data will be viewed. Then on Wednesday, we've got German industrial output, industrial production. Not expecting much from that because we know that Germany's economy is struggling at the moment, is in a technical recession. So the only thing that would be of interest here is if it came in above market maximum expectations, surprising to the upside, could see a little pop higher in the euro. Looking at the rest of the morning, pretty quiet. Got the Swiss Forex reserves and the Swiss franc. Now, just interesting to remember with the Swiss franc how strong it has become recently. If we just take a look at the strength here in the Swiss franc, you can see, look at the Swiss franc here, right up towards those highs that we had at the start of the year. This does put the pressure on the Swiss, and don't be surprised if we start seeing speak of intervention, rumours of intervention. SMB's Jordan's also always talked about, that this has to be taken into account now. The strength of the Swiss franc has been surprising the Swiss really with the resilience in the Swiss franc, and again, pretty resilient in this last week. So what we're looking for now is some kind of indication from the Swiss that they're getting concerned about this. And the reason the Forex reserves headline reminded me is because if we start to see signs of Swiss intervention, you'll see it here. And when they intervene, they're more likely to intervene by buying euros and dollars, and that can help weaken the Swiss franc. So just watch out for that. We're not likely to get anything from here, but just watch out for that general theme throughout the week. And that's just a little reminder to keep looking out for comments from the Swiss about the strength of the Swiss franc, and that could send the Swiss franc sharply lower. So look out for that potential opportunity. Then we've got the EIA crude data. We've seen a big dip in oil at the end of last week with the gain in the dollar. Got 10-year bond auction. Just check how that demand is. If we see weak demand in these bond auctions, that can allow the dollar to gain, and we can see yields pushing up, yen weaken. So just check the auction. It is a risk if you're trading the dollar at the time. If you get a weak bond auction, then we can see the dollar gain as yields surge if there's a lack of demand for the bonds. Looking on Thursday, PPI CPI print. Now, this will probably be looked at as a sign for demand in China, with the drop in prices taking place to try to encourage and stimulate activity. The slowdown in China's economy, couldn't be hinted at by how their CPI is. If it starts to pick up, then it's a sign that people are spending again, paying again. If this remains low or drops even lower than forecast, it's a sign that companies are having to drop prices to try to encourage consumers. Then we got the jobless claims data. We know how important joblessness is in terms of the Fed's policy, and Jerome Powell said that if they start to see a weakness or a collapse in the labour market, then they will be looking at cutting rates. At the moment, the labour market in the US is doing fine, thank you very much. So again, looking here, if we start to see big surprises to the upside and we start to see more jobless claims, then we can look for potential dollar weakness. If there's a minimum of jobless claims, as long as that regional banking sector crisis is not flaring up, then we could potentially look for some more dollar strength as the dollar sort of flirts with this 104, 103 range. It's trying to find a catalyst to break through, and there's just been a lot of contradictory data. Got the German inflation final data out. That shouldn't move markets at all. The Canadian data is worth looking at. The Bank of Canada have moved to a sort of more neutral position. They will act if they see inflation rising, and if you start to see a strong employment data, then that will give the Bank of Canada concerns that inflationary forces are brewing in the economy and should lift the CAD. A big drop off here in the employment metrics, and you start to see the unemployment rate rising and the employment change coming in below market's minimum expectations. Then we could look for some CAD weakness. That could be good to potentially trade against the US dollar if we see more positive US labour data throughout next week, and this regional banking crisis sort of starts to fade, then there could be some upside in the dollar CAD on a very weak CAD employment data.